Today's market call is brought to you by MoneyLion, the first digital ecosystem for consumer finance, empowering everyone to make their best financial decisions. Monday, April 21st, 11 a.m. on the East Coast. Market call. Dan, Nathan Guy Adami, hour and a half into the first market session of this week. Dan, how are you?
I'm doing okay, man. I mean, this is one of those mornings, though. You come in here, you don't know what, we're going to see on the opening here. We get a down opening, and then it just keeps going lower, and, so many headlines here. I know we're going to go through them. There's some earnings this week. There's some data this week. A lot of stuff goes on in the weekends that we have to contend with on a Monday morning, Guy, and at least for the last couple months.
Well, that's why the VIX is where it is, and I agree. And we've talked about this for quite some time now. Started in the fall for a lot of people last summer, in earnest on August 5th. But volatility has been and will continue to be a story outside of a couple days where we made a breach 20 to the downside. I mean, we've seen vol, 22.5, 23 and over for an extended period of time, which is something I don't think people have seen. Maybe in COVID, certainly in the financial crisis, yet here we are. But the story of the day, and Amanda made a nice little slide, and I think that's part of the reason the market took this next leg lower today, is what's going on, this continued battle between President Trump and Fed Chair Jerome Powell. And, the second bullet point I will take some umbrage with, although I take umbrage with just about everything, but calling Jerome Powell a major loser is for me problematic. I mean, he's a lot of things. I don't think he's a major loser. This is a Princeton grad, Georgetown Law School grad. He was editor of the Law Review, worked at Carlyle Group. I mean, he's got a pretty storied past. So, I mean, if you disagree with him, that's one thing. But, this name calling stuff, and listen, this is nothing new. I get it. So please don't at me. But, it's just not helpful. And, I will only bring it up because I think, and I'm sure Dan believes this as well, I mean, this next leg lower in the market is sort of part and parcel on this ratcheting up of rhetoric against Jerome Powell.
Yeah, I've been in the camp, and I know we've heard this a bunch by people, and again, it's a particular, it's not particularly a scientific sort of situation here. It's purely anecdotal. A lot of folks think these guys came in, they want to crash the market, they want to crash the economy, then they're going to be able to kind of rework global trade and all this sort of stuff. And, I just don't buy it. I just don't buy that, the folks, the powers that be in and around Trump, want to play chicken with the global economy here, because that's exactly what they're doing. And, when we talk about volatility, Guy, I don't know if you listened to this a couple weeks ago. Steve Eisman of Big Short fame had our good friends Danny Moses, Porter Collins, Vincent Daniel on his brand new podcast. It's called the Eisman Playbook. Go check it out in your podcast store. But, they had a great conversation, the four of them. They're going back and talking about their days together, investing, trading, shorting, the housing market in 07, 08. But I think it was Porter who said this. He's like, this right now, with what's going on right here. And they might have recorded it, I think, the Thursday or Friday after the Fed had blinked, or at least, President Trump had blinked on those tariffs. I think there was April 2nd that came out. On April 9th, they kind of reversed course. The stock market sold off 15% in a week. The bond market went haywire, right? And, to hear someone like Porter and maybe have Vinny sort of back it up and say that this is about as scary as the financial crisis. Now, the financial crisis was something that was brewing for years, right, in the lead up to it. And so it took extraordinary measures in late 08 and early 09 to get the markets, both the stock market, the bond market, every other housing market, every other thing to calm a little bit. But right now it feels like we're on the precipice of something. Now, I don't think that we have the sort of systemic risk that we did in the build up to the financial crisis, but what's coming next is possibly the unknown if we cannot take a step back from that sort of precipice, from that cliff. And how do you think when you hear those guys say that, does that make you a bit nervous? You know what I mean?
Because yeah, absolutely does. And they're not people to be hyperbolic. I mean, they're pretty even keeled, measured in their responses. I'd like to think that we are as well. And, in terms of what we're seeing, yeah, obviously 08, 09 had a certain set of circumstances leading up to, but the difference now is we have a global debt crisis. And I think the market is sort of coming to grips with that, with the backdrop of all, not only rhetoric, but, all the policies put in place or trying to be put in place coming, in my opinion, at the exact wrong time. There was a reason why, by the way, for people that say they couldn't see this coming. Well, I don't want to say we saw it coming. I don't want to be that glib. I don't want to be that sort of self-congratulatory. But what we did talk about was the fact that Warren Buffett's indicator was flashing red for months, if not longer. We had pointed that out time and time again. We pointed to all different metrics that were flashing red in terms of the market being expensive. We talked over and over again how you can't use those as timing tools. But what we did say, I think correctly, in the aftermath is it gave the market less and less room for error. And we're seeing it now. And there's another reason why Warren Buffett is sitting on a cash hoard of $335 billion. And again, he saw obviously something coming that people will say, well, he missed the move. He doesn't really miss anything. I don't think he's all that concerned about what he potentially could have missed because, quite frankly, what a lot of people have missed over the last 4 or 5 months now is that huge run up that sucked everybody in and the subsequent sell off. So let's pull up an S&P chart and sort of do a mark to market and where we are. And we drew that uptrend line. And if you go back to 2020 and just sort of show the trend line that we traded down to, that trend line we traded down to, we thought we could get down to 4,800. Well, we got down to pretty much 4,800 to the penny, as Carter Worth would say. I mean, the lines draw themselves. On the back of that, I know collectively we thought we could see a rally back up to 5,500-ish, would represent a 50% retracement. Got to 54.85 or something like that on that recent bounce. Close enough for government work. And now we're sort of in the second leg lower. The concern will be, I think, for most people, what happens if and when we get to that uptrend line? Because the next time down, Dan, I don't think we're holding. So this is it. I mean, you can make your bets now. You can say, you know what, Guy? The president's going to pull a rabbit out of the hat. He's going to tweet something that's going to get the market back on the rails. That could happen. Or this is going to continue on. And I'm not smart enough to know what's going to happen, but I will tell you that on top of very shaky fundamentals, which we pointed out for a while, now you're factoring in something else, which is very difficult to sort of price in.
Yeah, I mean, listen, I think we're going there, 48.50. I think we're breaking. I think we're probably going to go back to those late 23 sort of levels there. What is that, 42-ish or something like that? I can't see exactly. Maybe you can tighten up that chart. And I think that's just basically an amuse-bouche. I mean, because I am not sure what headline, what tweet can come out that could fix what's gone on over the last month and a half of this trade war. If they come out one day, let's say the S&P is at 4,200. Let's say the 10-year yield is at 4.9% or 5% or something like that. Let's say the US dollar is at 95, the Dixie, right? Let's say crude is trading at $52 and it got as low as 55. Let's say, who the hell knows where, all this other stuff, these macro stuff. Let's say gold is north of 4,000, that sort of thing. Like that is basically, like every basic warning sign going off, for a financial crisis, for a market crisis. I don't want that to happen. You don't want that to happen. Going back to early 2021 when we started this podcast and, Danny Moses was on with us on the then On the Tape podcast. There was an episode where we kind of, I can't remember exactly what it was, but it was like, Danny Moses saying something like, I love calamity. Right. And after, the period that we were just in with the COVID crash and then the monetary and the fiscal stimulus, then the risk taking that went on between crypto and NFTs and SPACs and the general market and non-profitable tech. I mean, anything that wasn't bolted down was being bought. Housing, Rolex watches, this or whatever. Back then, it made sense to cool things out. It was like a free-for-all when we were in the throes of a black swan. It made no sense. Here, it's a lot more dangerous right now because we have a whole host of things going on. If they had this magic tweet that came out 2 weeks from now, and under all those circumstances where I said risk assets, we might rally for a day like we did last time. We may rally 10%, but the problems then are going to be so much deeper. The lack of trust in our country and our leadership, right? Both, domestically, what we can do, internationally, the sort of relationships that we have made over the last 80 years in this kind of post-World War era that we helped define. I don't know how we get out of this. I really don't. And I think it's like a tear them all down, flood the zone. I mean, it goes on and on and on. we're going to have problems, whether it ended today or whether it ends a year from now, from here on out. I think our leadership on the global stage is going to be fucked up for years. I honestly don't know how we fix this.
Yeah, well, you have no valuation cushion either to sort of to buoy what you're talking about, and I think that's some of the things that we addressed. And now you talked about some of the concerns, and confidence is a word you use. So let's pull up a TLT chart, because this is basically not trading the way one would think. Again, I think we've been pretty clear as to what we thought was going on, but you're looking at a TLT chart that is now, we had that bounce in the TLT. We obviously saw yields plummet earlier this year on the back of a number of different things, growth concerns probably being the biggest thing. And then the subsequent move lower in the TLT, higher in yields, I think should be concerning everyone. And if Humatic sort of broadens it out a little bit and look at that October low, we made a while. Yeah. So you can draw a horizontal line across that bottom and you can see what I'm looking at. I've said for a while that I thought we're headed back down there. And right now it appears as though that's happening. The TLT in this environment, you would think there'd be a flight to safety in the form of the bond market. It's not happening. On top of which, one would think with the weaker dollar, you might see a commensurate move in yields. You're not. And this is something you mentioned, Danny Moses, earlier. This is something we had conversations with a number of different times over the last couple of years. There would be an environment where you'd see yields go higher and the dollar go lower, and that was not going to be a particularly healthy environment. And it's manifesting itself right before our eyes. And it's not just us talking about it. I mean, Janet Yellen brought it up last weekend on those Sunday morning shows. So she obviously sees it. A lot of people see it as well. This should be concerning. The weakness in the dollar is a confidence thing without question. The weakness or rise in yields is similar, and that's not a healthy brew, Dan.
Yeah. The other thing on a day like today where, Carter had a note out on worth charting and he'd been talking about this for a while on Market Call, on Fast Money, on his own work on the site. He like he hates mantras, like the higher for longer sort of thing. He kind of pointed out on numerous occasions when they had the 10-year yield. We had Rick Santelli on our show. He thought yields were going 10+%. Now, he didn't mean this year, this, or whatever, eventually. That may prove to be right. But he kind of highlights this morning, Carter, that, here we are at 4.35. Okay, maybe Amanda can kind of show that that link there. And basically 3 years ago, the 10-year yield or, whatever was 4.35, right? And so right now, if you just think about where we are, like, this last week has seemed pretty tame, right, guy? In the 10-year, let's be clear. And so if it starts moving up towards 5%, then we got a problem, because those are warning bells that are going to be screaming a little bit here, So the dollar is moving in a way that seems, pretty problemsome. You know what I mean? Problemsome, is that a word? If you start having this thing move back higher, it won't be, a huge move, 65 basis points if we're touching, 5%. But what it will be signaling is something that, to me, will be very troubling. And, in a day like today, when you have, maybe Amanda can pull up the XHB or the ITB, the ETF that tracks home builders, we're just dead flat on the 10-year yield. And look at how these things trade. Let's get a 1-year chart up. I mean, it's basically, retrace that entire move from late 21, which you've seen in a lot of things. Like, I just, what this says to me, guy, is that correlations. Let's pull up the XLP. Let's do the XLU. So if we have consumer staples, we have utilities, the stuff that's meant to be, defensive, they're trading down now, not so much. They're trading technically below those 200-day moving average. But, on days like today, if this really turns into a train wreck, if we see the S&P down 4%, we see the NASDAQ down 5 and 5.25%, and I see no reason why that couldn't happen. I'm not telling you, if you're a trader and you're watching this, go short anything that's not bolted down. I think it's going to be very difficult to short things, especially when the markets are down, or stocks are down, or individual securities are down, or whatever the hell is you're trading, commodities, currencies, yields. But I think we are in a 1 step forward, 2 steps back situation. And I think, rallies are to be sold. And it will be interesting to see the next big tweet. Is something, if the president blinks or something like that, really how much we have to the upside in the stock market. Because I think the more you do it, the less teeth that it has. The more you push out these deadlines, the less our adversaries, or those, even our allies who are trying to negotiate with on this sort of stuff, the less they feel that you are a steady hand to be negotiating with.
No, all fair. And listen, I think the stock market is an annoyance. I think the bond market is a warning sign, but I'm glad you mentioned home builders. Like, throw up a DHI chart for a while. And, again, I think we've done a decent job here. We've warned people that as much as people want to say it's a yield game with these home builders, it's not. And I get yields have been up and down. So just take Carter's point. Yields are basically, you want to say flat over 3 years. Well, these things are not. And to me, this comes down to basically consumer confidence. And it's also going to come down to the unemployment rate, which I think you're going to start seeing tick up in a meaningful way. So that's just DHI. You can pull Pulte Homes and Toll Brothers. They all look alike. There is zero bounce in these names. And that should be somewhat concerning. The other thing that bounced, but is now sort of retracing, I mean, pull up a Goldman Sachs chart. Look at some of these banks that had obviously a pretty significant bounce, maybe on the back of earnings, but they're starting to roll yet once again. And you have to continue to watch these because these were everybody's darlings. And in terms of these banks, you could pull up any one of them. They're all going to look very similar. Got through the 200-day moving average. We tried to make a run back up to it, and now seemingly failing again. I mean, JP Morgan, I guess, is the closest thing to potentially looking okay. But, there you go. I mean, a breach of the moving average, a subsequent test of it, and now flirting with it. I mean, the banks, to me, are another indicator that, maybe things aren't as great as people thought, at least going into this year and clearly post-election.
Yeah. BKX, let's just pull that up for a second there, if you don't mind, Amanda. Down about 23% from those recent all-time highs that we made just, a couple months ago. Actually, it wasn't an all-time high. 140 was the high here. I think going back to 2021, we had a high near, 150-ish or something like that. But to me, what's more concerning, Guy, is the KRE, so the Regional Banking Index. And coming into this year and shortly after the election, a lot of folks thought that deregulation would massively benefit regional banks, right? Especially after, the last couple of years that they had since the Silicon Valley Bank, sort of crisis there. And if you pull this out to a 5-year, I mean, this is trading down 27% right here. I think the BKX was down about 22%. I mean, this thing could go 40. It could go back towards those lows. These stocks are cheap. They're this, they're that, or whatever. But, some of the same conditions that we had when rates were going higher back in 2022 into the start of 2023 with some of these balance sheets that, were on these regional banks, that they were holding. I mean, that's a problem. And then if you think about commercial real estate and you think about all of this private debt that is being held, you know what I mean? And some of these, like, there's accidents waiting to be happening.
No doubt.
And you know what I mean? And I don't even think I don't even know if we've seen scratch the surface of these things, man.
Well, I mean, the last one was obviously probably going back to Silicon Valley Bank, and it's obviously a great Elvis Costello song, Accidents Will Happen.
Yeah.
In terms of Silicon Valley Bank, it was only hit and run, but doesn't mean another one's not sort of brewing out there. I agree with you. And I think so much of this to me is predicated on the job market. And if the job market starts to deteriorate, all these dominoes start to fall. We got a question from Chris L. How do you guys like the chart and fundamentals of Amazon? And then he sort of prefaced it, tariffs aside. I don't know if you can do this sort of tariffs aside, because to me, it's all sort of part and parcel. But if you look at where we are in Amazon, we're getting down to levels we saw in August of last year. And I think everybody remembers that August 5th day. So pretty big support level we're approaching. It's rolling over, though. The moving average for the first time in quite some time is sloping lower. I mean, that's something you have to take into consideration. There's been no meaningful bounce. I think you got to hold sort of 160 here, Dan. That upward trend line that was intact for quite some time since the lows in 2023 has clearly been violated. I personally don't see any compelling reason to go plowing into Amazon at these levels.
Agreed. And, stocks down 21% of the year, down 31% from those recent all-time highs right before they just reported that kind of Q4 result, gave Q1 guidance. One of the issues there was that, AWS, their cloud business, which, hosts a lot of these, AI models, Anthropic in particular, that they've been investing in over the last couple of years. So has Google. They saw deceleration in their cloud usage. If we see that again when they report next week, I mean, you better be careful here, because a lot of the narrative over the last month or so is that Amazon is actually cheaper on a PE basis than Walmart, right? And that was probably sucking some people in. And when you think about this, expected EPS growth this year down 8% and a reacceleration up to 21% next year in 2026. Well, you sell off 8% in your earnings, which actually might be generous if you think about it, right? If you think about the effect of retail sales here in the US, the potential for AWS to slow because we're going through this digestion period for generative AI, revenues this year expected to grow 9%. So if you have earnings going down or expected to go down with revenues going up, you're seeing a hit to margins. And we haven't even seen what that could look like in a protracted trade war, right? And then if that also comes with decreased advertising has been a big high-end growth area for them. It's been helping margins. If you see a decreased usage in cloud because companies aren't seeing the ROI or they're looking to cut back on expenditures on CapEx, then Amazon's going to have a problem, and it brings me back to 2021 into 2022. Let's look at what sort of peak to trough decline that we had going back there. I think a lot of investors, and we've been talking about this, they just forgot how much these stocks can sell off from its highs in 21 to its lows in 22. The stock sold off 55%. Just think of that. And you think down 30% can't be down 55%. It can't go down more than that in a protracted trade war that leads to a recession, that leads to a bear market that the Fed can't combat because the conditions in which they're trying to combat are not similar to COVID. They're not similar to 2022. They're not similar to the financial crisis. They're not similar to the dot-com. And they want to try, the president wants to and I think as you think, Fed Chair Jerome Powell has done a pretty nice job for the most part. Maybe there's been a little panics. Maybe there's been a little, lack of clarity or a little delay in, the interest rates and the inflation back in 21. But man, you want a guy like that who's been tested like this over the last 5 years in charge of things like this in an environment that we've never really seen before, or we haven't seen in decades.
Listen, all with you. So if you think Amazon's going to stop here, you're just playing a little bit of a stock market game. I do think there's more room to the downside. So we'll see. This question leads us into the Taiwan Semislide. So you might as well throw the Taiwan Semislide up and throw this question up from Earl Rothfuss as well. 10-year log chart for the SOX and 25-year chart for Russell predicting deep bear markets. Well, you want to throw a SOX chart up real quick, Amanda. We can take a look at it. Another one, I think we've done a decent job. We've pointed out time and time again that semis basically topped out in July of last year. We're almost approaching a year of underperformance of the semiconductors. So I think the SOX is concerning. And whether it's the SOX or the SMH, whatever you want to look at, there's a real chance that we're going to sort of, go down to the levels that we traded down to in late 22, early 23. And people will be like, no way. Well, there's a way. Now, it looks as though we may have stopped dead on an uptrend line from 2016. If Amanda wants to draw that uptrend from those 16 lows, we're basically right at it. But man, oh man, this is a spooky looking chart for sure, Dan.
Yeah, semis were the leadership largely because of, Taiwan Semi and Nvidia. Nvidia designs the chips. They have the software platform that the high-end GPUs run on. Taiwan Semi makes them. They make them over there in Taiwan. All this export bans, all these restrictions about who can do what, where, all this stuff about, okay, maybe there was a massive supply-demand sort of issue for the last couple of years. And now you have a situation where you could find yourself in a huge inventory situation, right? So think of this. If the Chinese were buying all these chips in the lead up to these export bans, even the ones that were rejiggered without the best technology that Nvidia has to offer, and now they can't get them or they don't need them because a company like Huawei, a domestic, chip maker, and maybe they can throw that one up, is about ready to ship, or if they haven't already been shipping. This was a Reuters article exclusive talking about this morning. Well, and all of a sudden, Nvidia might have an inventory problem. Nvidia might have a scenario where they've been pointing everyone to this Blackwell chip that's going to be more expensive than Hopper, that's going to be faster. And if they don't have use cases, then we got a situation where this stock, forget like valuation. You've been talking about this, out earning their or out kicking their coverage and this and that. Price to sales really expensive. PE's coming down. We haven't seen estimates come down yet. So as estimates come down, right, and the price, okay, comes down, it's going to be fine. It may look okay, but it depends how much those estimates come down. It depends how much the margin degradation comes. So I'm not ready to say, Nvidia, if you can look out 3 years, this is going to be a slam dunk because of CUDA, because of Blackwell, and then Rubin, and you guys have no idea what's going to happen as far as people who use these tools. I got no fucking idea. I mean, give me a break.
Yeah, I think we've been pretty, I don't know, we've been pretty steadfast in terms of the technical setups for Nvidia a few different times over the last year and a half. And then we've pointed out within the last few months that the fundamental story was really now not started to make a lot of sense. And say what you want. I mean, the move from 153 or whatever the hell the recent all-time high was to levels we're seeing now, I mean, that is a pretty significant sell-off. So you can be as bullish on Nvidia as you want. I mean, if you've been bullish since January, you've been wrong. And, this stock to me is still not out of the woods yet by any stretch. And we real quick throw that Taiwan Semi slide that we made, because there are a lot of moving parts in this entire thing. And, this is in some ways, I mean, this is the crux of a lot of the things that we've been talking about now, seemingly for the last couple of weeks. I mean, there's this back and forth between U.S. and China that Taiwan seems to find itself in the middle of, and these don't rectify themselves overnight, in my opinion. Real quick from Chris L. again, do you guys think it's strange amid all the intraday volatility we're experiencing every day that we haven't had a single circuit breaker? I'm going to be honest with you. Maybe you can ask like Chat GBT or something. I don't even know what the circuit breakers are anymore. Am I surprised by it? Not necessarily. I don't remember the last time that we saw one, quite frankly. But I'm not a big believer in circuit breakers either. If the market wants to go up, let the market go up. If it wants to go down, allow it to go down. Like I never really made sense to me that we need to put something in place to slow things down. Because in some ways, just my opinion, we've been prolonging the inevitable, Dan.
Well, when they do that, I mean, you get a pause. People get to kind of collect themselves and this and that, or whatever. But, rarely do they not go lower or break those limits. The first level down, this is using ChatGPT, drops 7%. Trading halted for 15 minutes. Level 2, if it drops 13%, another 15-minute halt occurs. Level 3, if it drops 20%, Jesus, trading stops for the rest of the day. I just want to say one thing. You and I have been very fortunate to learn a lot about the psyche of a retail investor, right? You've been doing fast money since it started 18 years ago. I've been doing it for 15 years. Through Risk Reversal, we've met hundreds of folks. We've communicated with hundreds of folks. We get to hear the questions when we're doing this live. We get lots of emails. And, forget the institutions. We got lots of friends who trade all sorts of things at banks, at hedge funds, at this and whatever. They should know better. They should have big risk controls, you know what I mean? That sort of thing. And hopefully none of these institutions blow up anymore. You and I go back to long-term capital in the late 90s. That should have never happened. Like all the what was it? When Genius Failed. There's a great book by Lowenstein. Go read that. When the .com thing imploded and a lot of these companies went under. GFC, we saw all sorts of companies, like go under, banks, no shortage of AIG and autos and all that sort of stuff. But right now, what you and I are most focused on are people who listen to our things, who watch our stuff, that sort of thing. And we're trying to hope, that people are not taking undue risks and here and there. But let's pull up a 5-year chart of Nvidia, because you like to use this term. Everyone's darling, right? Everyone thought that they could get shit rich just buying this because it was never going to end. And you and I never knew when it was going to end. But if you go back and you look at late 21 and you see that sell off to the lows in 22, it doesn't look like much. That was 70%. So if you bought in late 21 because you thought that they were going to change the world, well, they didn't. It took them until late 23 to really kind of, at least through the lens of their stock, to do that. So you're buying this thing the whole way up, and it's amazing. The story's amazing on TV. Every other 98% of the people talking about this name were amazingly bullish right up until a couple months ago. But look at how the volatility bands widened. If we had volume on there, you'd see, right, as this thing gained $3 trillion in market cap. So if you don't think on the way down it can overshoot to the downside, well, then go back to 2021 to 2022. Go look at all the money that's piled in here, whether it was active investing, whether it was retail investing, whether it was passive investing, because it came one of the biggest things. And you say this all the time, when passive goes active, there's no reason why this stock couldn't sell off 50, 60, 70%. And I know that sounds crazy, but we've been highlighting the fact that Netflix and Meta and Tesla and Nvidia all sold off 70% from their highs in 21 to 22. What is different this time, Guy?
No, in my opinion, not a lot. I mean, history rhymes without question, and everybody says it's this new paradigm. It is different this time. It never is. Before we get out of here, the gold market continues to perform. That makes a lot of sense. That's something we've been harping on now, seemingly for the last few years. So a lot there. We want to get out of here because the Risk Reversal podcast is about to start, but we got a lot of great conversations this week. I'm about to talk to Daniel DiMartino Booth. Dan has Gene Munster. A lot of people. I got Danny Moses later in the week. So stick around, folks, because we got a chock full broadcast week for you.
Yeah, no doubt. Hang in there, people. We'll see you tomorrow.